Hey everyone, welcome back to Corporate Decoder, the place where we cut through the jargon to find the real story behind the numbers. Today we're diving deep into eGain Corporation's 2025 annual report, and get ready because this one's got a few surprises, especially when it comes to their bottom line and how they're handling their finances. Let me tell you, it's not every day you see income shoot up this dramatically, and we're going to find out why. Before we dive in, if you like getting these plain English breakdowns of complex financial documents, make sure you hit that subscribe button and the notification bell so you don't miss out. And hey, if you want to chat more about these kinds of insights, join our Discord community. Link is in the description below. Hans, well, before we dive in, if you like getting these plain English breakdowns of complex financial documents, make sure you hit that subscribe button and the notification bell so you don't miss out. eGain Corporation, as of June 30, 2025, is presenting its yearly report to shareholders and the SEC. It's a big document packed with details, but we're going to focus on the juicy bits, like how much money they're making, where it's coming from, and what risks they're facing. Let's start with the money. Their total revenue for the year ending June 30, 2025 was about $88.4 million. Now that's a bit down from the previous year, which was around $92.8 million. So a decrease of roughly $4.4 million. A big chunk of this revenue, about 93%, comes from their SaaS or software as a service offerings. This means customers pay a regular fee to use their software, which is a pretty standard business model these days. Looking closer at that SaaS revenue, it dropped by about $3.2 million or 4% compared to the year before. That's not ideal, especially when it's their main money maker. The rest comes from professional services like implementation and consulting, which also saw a dip. It seems like customers are spending a little less on those services. While the overall revenue is down slightly, it's important to see where this is coming from. With SaaS being their primary income source, that decrease is definitely something to watch. Now, here's where things get really interesting. Despite the slight drop in revenue, their income from operations actually took a nosedive. For the year ending June 30, 2025, they reported an operating $9 million in operating income they had the year before. This means that even though they made a little less money, their costs went up, eating into their profits. But wait, there's a twist. When you adjust for things like stock-based compensation, which is basically the cost of giving employees stock or options as part of their pay, their non-GAAP income from operations looks quite different. For 2025, this adjusted operating income was about $6.8 million compared to over $10 million, compared to over $10 million the year before. So even with adjustments, the operating performance isn't as strong as it was. This suggests that while stock compensation can be a fluctuating expense, there are other underlying costs that are impacting their profitability. One of the biggest bumps in their expenses is in research and development. This means they're investing more money into creating new products and improving existing ones. R&D costs went up by about $3 million, which is an 11% increase. This is often a good sign for tech companies showing they're innovating, but it also means less money goes to the bottom line in the short term. Interestingly, their sales and marketing expenses actually went down by about $2.8 million. This decrease of 12% might mean they're cutting back on advertising or perhaps optimizing their sales efforts. It's a strategic move that could be aimed at improving efficiency, but it could also hint at challenges in driving new sales. General and administrative costs, which cover things like legal fees and executive salaries, also decreased by a significant $1.9 million, an 18% drop. This could be from cost-saving measures or maybe specific one-time expenses in the prior year that didn't repeat. Now let's talk about the most eye-popping number, net income. For the year ending June 30, 2025, eGain reported a net income of a whopping $32.2 million. Now compare that to the previous year's net income of just $7.7 million. That's a massive jump, more than 4 times higher. This huge increase is largely driven by a significant tax benefit. Specifically, they recorded a benefit from income taxes of $26.6 million in 2025 versus a provision for income taxes of $1.9 million in 2024. This difference is primarily due to the release of a valuation allowance against their US deferred tax assets. Basically, they previously thought it was unlikely they'd be able to use certain tax credits or benefits in the future, so they set aside money against that possibility. But now they believe they will be able to use them, so they've reversed that setting aside, which creates a big positive impact on their net income. It's a complex accounting maneuver, but the outcome is a much higher reported profit. This release of the valuation allowance is linked to their US net operating loss and credit carry forwards. They believe they will be able to utilize these in the future, especially with recent California legislation impacting how these can be used. It's a sign that their future profitability outlook has improved, at least in the eyes of their accounting team. Looking at cash flow from operations, it decreased to $5.2 million in 2025 from $12.4 million in 2024. This is partly because of that big reversal in deferred taxes, which boosted net income but didn't bring in actual cash this year, and also other changes in how they manage their assets and liabilities. On the financing front, they've been actively buying back their own stock. In the 3 months ending June 30, 2025, they repurchased over 630,000 shares. As of September 2025, they even approved another $20 million increase to their repurchase program. This shows they believe their stock is a good investment, and it can also boost earnings per share by reducing the number of outstanding shares. An interesting detail is the cost they capitalized to get new revenue contracts. They're deferring these costs, mostly sales commissions, and spreading them out over about 5 years. For 2025, they capitalized about $865,000 and amortized $1.4 million, meaning it's a net reduction in their sales and marketing expenses for the year. Now let's talk about the risks. Like any company, eGain faces challenges. They acknowledge that their business is heavily influenced by things they can't control, like the overall economy, currency fluctuations, and customer adoption of cloud and AI solutions. This is pretty standard business talk, but it's always good to be reminded that things can change rapidly. A major risk they highlight is intense competition, especially in the customer engagement software market, which now includes generative AI. They are up against big players and smaller, agile companies. If they can't keep up with innovation and customer needs, it could really hurt them. Their investment in R&D is a direct response to this, but staying ahead is always a challenge. They also rely on partners to sell their products. If these partnerships don't work out or grow, it could slow down their revenue growth. Think of it like having great products, but not enough people to sell them effectively. Cybersecurity is another big one. A breach could mean losing customer trust, facing lawsuits, and significant financial penalties. They've got plans in place, but the threats are always evolving, so it's a constant battle. Data privacy laws like GDPR are a growing concern. Keeping up with these regulations across different countries is complex and costly. Failure to comply can lead to hefty fines and damage their reputation. The auditors, BPMLL, have given their stamp of approval on the financial statements, saying they present fairly in all material respects. However, they did point out revenue recognition as a critical audit matter. This means that determining how and when to recognize revenue, especially with complex customer contracts involving multiple services, requires significant judgment from eGain's management. They had to evaluate the company's methods for setting standalone selling prices for services that aren't sold separately. This level of judgment means there's always a higher chance of error or interpretation differences. Looking at the balance sheet, their cash and cash equivalents stand at about $62.9 million as of June 2025, down from $70 million the year before. Their total assets are around $148 million. On the liabilities side, those current liabilities are a bit higher than their current assets, but this is offset by a strong stockholders' equity, which has grown significantly from about $58.5 million last year to $80.7 million last year. This growth in equity is thanks to the positive net income and that big tax benefit. So while revenue saw a slight dip in operating income before adjustments decreased, the massive surge in net income, largely due to that tax asset release, paints a very different picture of the company's financial health for the year. It's a reminder to always look beyond just the headline numbers and understand the story behind them. So what's my take on all this? eGain is navigating a competitive market, investing heavily in R&D, which is a positive sign for future growth. However, the dip in revenue and operating income before those one-off adjustments suggests that core business growth might be a challenge. The huge boost in net income due to the tax benefit is a significant accounting event, not necessarily a reflection of improved day-to-day operations. They are actively managing their capital structure by buying back stock, which can benefit shareholders. The biggest risks remain in competition, cybersecurity, and navigating complex global regulations. Overall, eGain seems to be in a phase of reinvestment and strategic adaptation. The numbers show a company facing some revenue headwinds, but making a big splash on the net income line thanks to a substantial tax benefit. It's a story of strategic investments, accounting adjustments, and the ongoing challenges of a competitive tech landscape. What do you all think? Does that massive net income jump excite you, or do you see it as a temporary accounting boost? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate deep dives. And remember to join our Discord to keep the conversation going. Thanks for watching Corporate Decoder, and I'll see you in the next one.